Everyone, welcome to Credit Score and Why It Matters. My name is Fernando Garcia. I'm an investment advisor representative here at Excel Wealth Management. Before we get started, though, I do want to share a little bit about my background. Before coming into this area of work here at Excel, I used to work in the auto finance industry and got to see the good and the bad when it comes to credit. So today we're going to go over how credit works and how to improve your score and take advantage of the benefits that come with higher scores. As always, this is for education purposes only. And if you guys have any questions, please feel free to leave them in the Q&A box and we will get to them at the end of the presentation. All right, so credit score. So there is FICO and there is VantageScore. These are some of the most used credit scores, but we're going to focus on FICO as it is used by 90% of US lenders. So banks, mortgage companies, credit card companies. A credit score is measured by a 3-digit number, anywhere from 300 to 850. Now, this rates your credit worthiness. And it is based on your credit history. It tells lenders how much risk they are taking by lending you that money. So basically telling them your ability to repay those loans. Who uses credit scores? Well, you have lenders, so again, bank, mortgage companies, credit card companies, landlords. When you're renting, actually from personal experience, I remember when I was renting before I purchased my house, I saw in the listing, if you had a lower credit score, you had to pay more on rent. So again, they do look at that. Utilities, they look at that to determine if a deposit is needed. Now let's get to the good stuff here, the calculations. What makes up this credit score? So you have credit history at 35%, amounts owed 30%, length of credit history 15%, types of credit 10%, and new credit 10%. Now, if we look at the two biggest ones, the credit history, amounts owed, I would say those are going to be the most crucial ones, right? So credit history is just going to come down to whether you're paying your bills on time. Amounts owed, how much debt do you have versus the actual credit limit. The length of credit history, this is going to be the amount of time the account has been opened. And then you have types of credit, so like the credit mix. Are you diversifying your accounts? Do you have credit cards, auto loans, mortgage, all that stuff in there? And then new credit is just going to be looking at whether you're opening too many accounts at once or within a short amount of time. Telling lenders that you might be taking on additional risk, and that's where they base their decisions. Now let's talk about good credit versus bad credit. Remember those three little numbers that we talked about earlier? So here's an example. You have poor credit all the way to exceptional credit. Now, what if I told you the average FICO credit score in the US is 715? So that's right down the middle. And only about 24% of Americans have an exceptional credit score of 800 and above. So having a very good or excellent score can save you thousands of dollars over time, not only in lower interest rates, but better loan terms. Bad credit can mean higher interest rates or being denied altogether, and that's never good. But why does that matter? Your credit score is a reflection of your financial habits, and maintaining a good credit score helps you stay in control of your financial future. And that comes in ways of, saving money through better interest rates, getting approved for credit cards, getting approved for housing, but most importantly, setting yourself up for a better financial future. Again, setting yourself up for a better financial future. Now let's look at a quick example. So we have two people. buying the same vehicle, same amount. They both looking at a 5-year term. One person A, has an 800 credit score and got an interest rate of 4%. And the other, you have a 620 credit score with a 10% interest rate. Now, the payment difference might not seem too much, but $70 per month, which equals $4,200 on a 5-year loan. So now think about it this way. These $70 are going to the bank, so you're making them money, right? You're making them money. Why would you want to do that? Why not keep that money and make it work for you, right? Let's look at an example of how we can make that happen. Now, this example is for illustrative purposes only, and it is based on historic performance from the last 5 years. If you would have put those $70 that are going to the bank, and you would have put it into a growth mutual fund, you would have had an additional $2,400 to total that $6,600 with your investment, right? Now let's look at it a little bit farther into the long-term benefit. If you were to leave those $6,600 invested in a 30 years with no additional savings into a 60-40 portfolio that averages 8% return, your $6,600 investment could turn into a $65,000 retirement savings. Now, that is not pocket change to me. So again, would you rather make the bank that money, or would you rather have it for yourself for that retirement future? So now you see how every dollar can impact that financial future. And now let's look at how you can increase your credit score. So some of the best practices are also going to help, again, increase your credit score. And we have to focus on what's going to make the biggest impact. So, credit history. Are you paying your bills on time? Right? How can you do that? Well, you forget. How about setting up autopay? Setting reminders. Now, the amounts owed, I would say keep your balances low. Try to stay under that 30% of your credit limit. So if you have a $3,000 credit card, stay below $900. The length of credit history, do not close old accounts, especially those where you have made and have a really good payment history, because once that credit card has been closed, all that history will go with it, and that will affect your score. Now, with the types of credit, are you diversifying? Do you have, auto loan, mortgage, credit cards, right? Diversify the money that you're borrowing. Avoid opening too many accounts at once. And the most important, I will say, will be the check your credit report regularly. You have to look for errors, right? Go in there, make sure that the bureaus have not reported something incorrectly, because if they do, you can always call back. And like they say at the Housewives of Beverly Hills, have your receipts ready to go. Now let's talk about some of the myths here. Number one, checking your credit hurts your score. Well, that will be considered a soft inquiry and will not have an impact. What will have an impact is when you pull your credit to open an account. That's what's going to hurt it. That's what's called a hard inquiry. You need to carry a balance to build credit. Well, what if I told you that if you do not pay your balance in full by the due date, you will have to pay interest rate, right? You have to pay the interest on that. And what if I told you that the average interest rate for a credit card for 2025, it is 24%. So if you have a balance of $500 and you do not pay it, they're going to charge you an additional $120 that could have gone into your retirement account. Now, the next one, you can fix bad score overnight. Well, actually, Mitch made a really good point. It's kind of like your fitness, right? Like if you go into a diet, it's not going to happen overnight. Just because you ate a salad last night doesn't mean you're going to lose, 30 pounds. Same thing goes here. Slow and steady wins the race. Improvements take time, and you just need to stay disciplined and consistent, and just play the long game. You only have one credit score, like we talked before. You have many scores. The most used is going to be FICO and VantageScore. But again, FICO is the most used at 90% by lenders. Now let's look at some of the resources. So you guys know FICO and VantageScore, they both pull from these three bureaus: Equifax, Experian, TransUnion. I'm sure you've seen TV ads about these three. And here you have some of the free resources to check your score. One that I personally use is going to be Credit Karma, that does a very detailed report of your balances, all your credit cards, how much you're using, payment history. They do a really good job of check mark or an X. Luckily for me, it's all been check marked. But that's one of my favorite, and it's free. I'm sure they have some paid stuff, but to me it works. Now, another one of my favorite is going to be the bank or the credit card provider. I'm pretty sure all of you guys have a bank account and a credit card. And if you don't have your account set up yet, to look at it either online or through an app, I would say do that, because they make it very easy for you guys to check that score for free. Another resource that we have for you guys, it is our Accelerate app. This is financial planning at your fingertips. You can do many things, from budgeting to debt management and many, many more. You can spend 3 minutes per week to build better financial habits while you keep track of every dollar you spend. If you want to improve your financial wellness but do not know where to start, this app is a fantastic resource. All you have to do is go to the Apple or Android App Store, type Accelerate by AWM, and create an account and get started. If you have any questions, feel free to reach out to us, and we'll be able to help you out with that. Stay tuned for our next roadmap series, which is going to be on the difference between pre-tax and Roth savings. I know that's one that a lot of people kind of get mixed up and don't know, which one they should do. If you don't, feel free to sign up for that. Also, check out our video library and watch any of the past recordings if you missed them. And that is it. If you guys have any questions, feel free to reach out to any of us, and we'll be here to help.